having like if you have it's not your primary residence, if it's an investment property, it's kind of easier to do the renovation loans, in my opinion.
Hindsight being 2020, if I were to start over again, instead of buying a single family house, I would buy a multi-unit.
What's a big mistake people make is that first house they buy is way too expensive because they get caught up in there and they're never able to save up money for that next move. Right, leverage. I mean, leverage, to put it in simple terms, it's basically, how much money do you have to put down out of pocket out of a deal, right? How big of a loan can you get to actually make the plan work?
Welcome, my beautiful people. Today, I'm super excited because I have an interesting podcast for you guys. We're going to be talking about leveraging or mastering leverage and the form of using institutional money to jumpstart your real estate investment journey. And my guest today is Aaron Hassinger. He's been in the industry for a very long time, super knowledgeable. I know you're going to get some value from this podcast. So, without further ado, Aaron, tell us who you are and tell us more about you.
Hey, so Aaron Hassinger, I'm a mortgage broker in Florida, celebrating my 20th year this year, doing mortgages. So thank you. And a little bit about my story and who I work with mainly is, you know, I just found like over the years of doing as a mortgage broker, it's paperwork. It's just always paperwork, getting burnt out almost. And I realized like I'm helping this certain group of investors, a couple groups like over the years, like literally make millions. Like I saw how they did it. And I'm like, why don't I actually put this use to my own good and start sharing the info on how, like, what is the best pathway to really build your way up in real estate? And that's what I do now.
Yeah, awesome, awesome. So, and for you guys, a little bit background on our relationship with Aaron. I just joined this awesome networking group here in the Greater Fort Lauderdale area, and Aaron is one of the leaders. And I'm super blessed to have him. But Aaron, can you explain the concept of leverage in real estate investment and why it's such a powerful tool?
Right, leverage. I mean, leverage, to put it in simple terms, it's basically, how much money do you have to put down out of pocket out of a deal, right? How big of a loan can you get to actually make the plan work? Um, so I think is really important. Do you want to get into like what I think the best move is to start if someone's
Well,
starting out?
yeah, yeah. So, because my follow up question with that and I want to really gear this conversation towards really the beginner investor, and for those that follow my podcast and are longtime subscribers, you guys know my story, right? I started as bought my first home at 18 as a first time home buyer, but with the mindset of that home being an investment. And that's where I want to gear this towards. So whether you're a seasoned investor and you're gonna get some tips on some of the programs that Aaron has that we're going to talk about, like loans for repairs and how to finance your deals. But the first question, let's really gear it towards the first time home buyer and how they should consider using a mortgage to buy their first, not only home, but their first investment.
Mm-hmm. Okay. Well, let's start off with the most traditional way to do it, and maybe a lot of times one of the best ways to do it for most people is an FHA mortgage.
Awesome.
FHA loans, you can go up to 4 units, right? 4 different houses, um, and only put 3.5% down. That's a big deal, and that's the way it's been for a long time. So I think, that's something people should consider. On the conventional loan side, which is generally has stricter standards to qualify for, right? A conventional loan. But they changed that. Now you only need to put 5% down on those properties, where in the past it's been like 25%. So I think that would be the best way for someone to start out.
Yeah, I can't agree more. So, you know, hindsight being 2020, if I were to start over again, instead of buying a single family house, I would buy a multi-unit, and without really going into too much into the weeds, with a FHA loan and a conventional loan, and correct me if I'm wrong, Aaron, you can buy up to 4 units because they're classified as residential. So if I were to start over again, that's how I would buy it. So my first home was a single family home, but today I would buy a 4 unit or 3 unit or 2 unit home, because not only can I get this property with either 3% or 5% down, but once I get it, I can immediately start learning how to be a landlord by renting out the other units, which will help me offset the cost, if not pay for the mortgage altogether. Do you agree, Aaron?
Totally agree. And as a mortgage broker, let me give you some little known facts about how it actually works and how you get qualified for it. Because a lot of people, like, correct me if I'm wrong here, Fernando, like, the biggest thing that gets in the way of most people from actually taking action and starting their real estate career is like whatever's in their own head. Really, like, they don't know what they don't know, so they don't even try. But people are surprised to find out that if you buy a 4 unit property with an FHA loan or with a conventional loan, actually, the rent from the other units counts as income, right? So you can qualify for FHA right now on a 4 unit here in Florida where I live. You can get a maximum loan amount of $958,000 with FHA.
Wow.
That's only putting 3.5% down. And really, those other units are counting as income to help you qualify for that. So I think that that is the best way to start, because as you go on and try to get your second piece, you can only have an FHA loan as your primary residence, right? And you can only have one FHA loan at a time, granted some far off exceptions. So going forward, after you get that first multi-unit property, you will be looking at 20-25% down. It's harder then.
Right. Right. So you have to. I like that. I like that. And now I get this question all the time, especially here in South Florida, or even in the Central Florida area and South, that finding a property that doesn't need a lot of work. It's number one expensive, and number two difficult because you're competing with a lot of people. But I always tell people, don't do that, right? Especially if it's your first home, buy a fixer upper. So, Aaron, are there programs that someone can get into that'll help them finance the repairs on these properties?
Totally. And this is where actually I think having like if you have, it's not your primary residence, if it's an investment property, it's kind of easier to do the renovation loans, in my opinion. But yeah, even if it's your house and that first house you buy is a fixer-upper, there's the FHA 203K, which is a renovation loan, which basically, if the deal makes sense, they'll finance 100% of your renovations. That loan, I don't know if you've ever done one, Fernando. There's a lot of red tape. Um, but that's okay. If you know, like, this is sort of like in my long-term plan, I'm just going to deal with the red tape. It can totally be done. And then there's a conventional version, which is a little bit less red tape, called the Fannie Mae Home Style Renovation, right? So those are two loans that pretty much anyone could use to get renovation funds for their house.
Yeah, let's dive a little deeper into that, because I personally have not taken advantage of FHA. What was it, 203K?
Yep.
I've not taken advantage of that specific loan, um, or a conventional version of that. I really have not taken advantage of that. But, like, for example, I currently have a client that we're going to be working with together, that you just found out because I haven't told you about it. But I have a client. She's a young, hardworking woman, and she's looking to buy a her first property, but I'm gearing her towards getting a multi-unit property so we can add the income from the second unit to help her qualify for the loan and give her some immediate help and relief on the mortgage payment, right? You know, today's unfortunately in today's economy, today's young generation, they're struggling to get into these homes. But it's because they really are not educated on how to do it. So walk me through the process. If I find her a let's say a duplex that does require some work, but she's going to be living in one and renting out the other. What are her steps? Like, what? Walk me through that process.
Right. So this is before she buys it or after she buys it?
We have the property now.
Hmm.
It's a duplex. Um,
Right.
it does require. It's going to require some work. So walk me through the process of how we're going to walk her through this.
Okay, yeah. So it's yeah, good question because it's important in the beginning to do the right steps in the right order, right?
Right.
So first step would be to get a general contractor over there, a set of with plans at least or drawings of what you're going to do and a budget of how much that's going to cost. Once you have that budget and you can start making the offers and whatnot. But really, what she would want to do is get pre-approved for maybe the FHA 203K loan on something like that. Just get pre-approved, make sure she qualifies for it. We would definitely want to know what is the market rent if she's adding a unit on that would be. And we can ask the appraiser to figure that out as well. But we need that because remember that rental income from the other unit is counts as income for her to qualify. So um, the appraiser would notate that, and we would use that. So if it's like 2,000 a month, an extra 2,000 in income. But those are the first steps, right? General contractor, budget, and then get pre-approved.
Okay, and then that pre-approval process, she'll need to supply you with what?
So, like I said, these loans are, if you're going to think about red tape, this is at the highest level, right,
Right.
of loans that are out there, right? So, she would probably need to provide last 2 years tax returns with the W-2s, her pay stubs if she works for someone, last 2 months bank statements, driver's license, and with that and the budget, and the more or less comp on what the rental price will be on other units, that's we could figure out is this person going to be approved or not.
Okay, awesome. And then, because you kind of touched on that, but give me some of the key factors that lenders look for when approving a mortgage. Both and a mortgage like this one, where it's going to be her residential, but it does have another unit where she's going to get some income. Or let me backtrack.
There's a key factor that differentiates this,
Yeah,
and
that's
that's
let's
that's
talk about that.
that's your debt to income ratio, right? So if it's your primary residence, they're definitely calculating your debt to income ratio, which means a lot of times for investors, a lot of investors, self-employed people, their accountants are having them show that they make the least amount as possible, right? So it can be tricky, right? Um, as if it's an investment property, I kind of touched on it earlier. It's actually easier to get these renovation loans because it's not going to be red tape if it's an investment property. It's basically based off of the numbers. Does this deal make sense? And will the rent cover the payments? They call it a DSCR loan.
Right.
Um, even on the renovation loans and new constructions, they're not going to ask for income documentation on an investment property. That's pretty big, right? Like, did you know that, Fernando?
No, I did not know that.
Yeah.
I'm
Most people don't know that. Yeah.
Yeah. No, I didn't know it. Like I said, I've been kind of fortunate in the sense that when I started really becoming a true real estate investor, because again, in the past I would buy a property, live in it for a couple of years, save a down payment for my next property, move out and rent that out. So I did that for multiple years. But when I started becoming a true investor, I was fortunate that I had cash and I had partners that would give me private money. It was easier for me to move, and I would burr property. I won't bore people right now on the burr process, But basically, I use the same funds to buy, repair, rent, repeat that process with the same money. Right? I would use the same. At the time, it was really $200,000. I would use that same $200,000 to build my portfolio. And then today I have the cash. So I'm really learning here as well because I want to go back to leveraging some money because it's finding deals today is not as easy. And I'm a long term real estate investor, so I don't mind paying retail because I'm going to keep the property for a while anyway. So I'm really enjoying this conversation because I'm kind of learning here. So uh, going into that, there's so if I hear you correctly, as an investment property, um, it's easier to get a loan for repairs. But what's the difference between buying a residential property that doesn't need repairs and we're getting a regular loan versus an investment loan? Like, is there a difference in credit score and down payments, etc.?
Definitely. So let's see, on the investment property loan, it's generally going to have to be 80%. Like they'll go up to 85% of the ARV. If you want to explain that, you might
Yeah,
be better than me. Like
yeah.
that's
The ARV is the after repair value
right.
value of the property. So yeah.
So your total amount borrowed can't be more like with your if so this actually comes up more often with people who already own the property is what I found. So maybe there's some listeners out there who own a property who are thinking about adding a unit. Like that's pretty easy. As long as it's not their primary residence or they move out, like it's pretty easy to do the investment property loan, which again investors like because there's really no red tape, you know it's smooth. But purchasing with plans to getting the renovation loan right off the bat can totally be done, but you have to have that general contractor relationship and have them be on the ball, because with to answer your question, as a primary residence, they only really have to have the 3.5% down on one of these loans you know and
That
then if you really want to go buck wild, there's first time homebuyer programs out there. Like I try to sign up, make sure I'm signed up with all of them, free money. But if someone's doesn't own a house, they want, like your client, maybe this is her first house, she wants to start out with a bang, doing the best move, going this multifamily route, and maybe doing some renovations. The FHA loan's 3.5% down, and maybe she qualifies for down payment assistance you know
Awesome. So let's talk about that. How does, what programs are out there and, are there, I know they're going to require some kind of red tape, but how do you qualify for these assistant programs?
Um, I would recommend calling someone like me, like who's a mortgage broker, because they're gonna have more access to this. Because, like, let's say I'm not trying to represent my profession, and you're a buddy of mine. I'm giving you the inside info here, right? Mortgage people don't want to do first time homebuyer programs. I said it. Like, it's extra work for us. There's no extra pay. I'm telling you. So that's why, like, you got to find someone who really wants, like me, like my team, Angela. Like we love to help people with this stuff because I think it's awesome when someone can get their first property. But search around, ask more than one person, go online. To qualify for most of these programs, you have to have a 640 credit score or higher. Okay, so 640 credit score or higher. You could not have owned a primary residence in the last 3 years. And then a lot of times there are like income caps. So if you make too much, it's done by zip code. If you make too much, you won't qualify. But I would just get with someone who does them, like a mortgage broker, and ask them, hey, show me all my options, first time home buyer programs. They're out there.
Yeah, I can't express that enough. I've helped a couple of first time home buyers, and we've got into some of these programs. So, like for example, and each city will have different amounts and different requirements. But some of this funding comes from, and let me know if there's other areas to look at. But we normally look at city programs. Like for example, the last client that I had who bought a condo in Plantation. We went to the city of Plantation and asked, "Are there any programs for first-time homebuyers?" And sure enough, there was grants, uh, and we applied for those grants. But uh, can you give us an idea of where they can look to get these programs, or get into these programs?
Yeah, yeah, yeah. If someone really knows, like you said, the city that they wanna purchase in, like the city of Plantation, first stop should be there because they'll give out bigger grant amounts. I did one recently for the city of Hollandale Beach, and the client got 45,000 for down payment assistance. Like he doesn't have
Wow.
to pay that back. He doesn't have to pay that back, you know?
Wow. Wow. Yeah. That's
I mean,
another
there's certain
one.
there's certain restrictions on it because any gamers out there trying to game the system, like if you sell it in 5 years, like they recapture, there's certain clauses. But yeah, so start at the city level if you know the city. Next, go to the state level. Hometown Heroes here in Florida has been a big program. The thing is like they sometimes they have money, sometimes they don't have money. Like so, if you call them and they say I don't have money, you almost gotta like bug these guys, become friends with them at the city. I'm telling the truth from the people I've seen that have been successful in getting the money from the cities. Because when they get like $3 million in, it goes so fast
Yeah.
that you almost have to be like the squeaky wheel over there and make sure like, okay, you don't have money now. Can you please let me know, when it comes out and maybe send, a box of brownies over to their office or something. You want to make friends with them.
Yeah. So one more question on that because you kind of touched on it. So let's talk a little bit about credit score. You mentioned that to qualify for some of these programs, you got to have a 640 credit score or greater. For someone that has like my client who has no idea, she's a 21-year old, doesn't knows nothing about credit scores, but how difficult it is to have a 640 credit score, and are there other programs that require higher credit score or lower credit scores?
Yeah, credit is one of the key components, your credit score, of qualifying. Um, so let me make a prediction on your client, right? I don't know what her credit score is, but probably buying the property first just with an FHA loan is what would happen because the chance of her pulling off getting plans for an addition, you have to get an architect for that. And architects take, I'm telling you from experience, like 3 to 6 months and you're lucky.
Right.
Seriously, that's how long they take to get all your plans. So, but credit score, where that falls in place on these renovation loans, I mean, I said 640, but really probably on a renovation loan, you want to be closer to 680. Um, it's hard for me to say. I think people should always check locally because these things change all the time, right? Depending on the program. But for investors, 680 credit score would be a target point of like that's what you want to have. And that's really not too hard to get, a 680.
Yeah, I tell people all the time because people always ask me, and I'm like, listen, if you have a credit card or a car payment and you've been making your payments, you're probably higher than a 640. So it's not that difficult. Now, if you're missing payments or paying late, then that's a different story. But for the most part, a 640, 680 credit score, it's really not that difficult to obtain. Um, so I'm glad you touched on
And
that. Now,
can I add something
yeah,
on that?
yeah,
So let's say you went through a divorce and legitimately you got a 500 credit score. Should you quit or wait? Like I've seen people, pull it off where they say, like you brought it up before, they partner up with people for the piece they're missing, right?
right.
If you don't have the money, you go in together on these things and really so where there's a will, there's a way. Even with no credit, bad credit, I've seen people purchase multiple properties through partnerships,
No, and I,
co-signers, things
I
like
I'm a
that.
big right. I'm a huge fan of partnership because that's how I was able to build my portfolio. Um, you know, and partnerships can be done in many different ways. You can get someone to co-sign with you. You can get a partner to lend you money. There's a lot of different ways. If those of you that are interested in learning more on partnership, just comment below partnership, and I'll get back to you because I have a lot more questions to ask Aaron here before this segment is going to be up. But let's talk about some creative ways to get into investing in real estate using, for first time investors, um, using something additional than a conventional loan.
I got one for you. And I'm for if there's any other mortgage brokers out there, don't be commenting that I'm not giving like every detail of this because I don't know every detail of how this works. But here's a creative one I have for you. Here in Florida, um, if let's say you qualify for an FHA loan, like you have a job, you have the credit, you have the assets, except, one of the requirements is 2 years on the 2 years of employment without a gap, 2 year history, right? Let's say you don't have that. Or let's say you do have that, but you don't have the credit. The point is you're missing one of the pieces you need for an FHA loan. Um, for a half point in fee, there's a program out there where an Indian tribe actually closes the loan, and they're the only ones that FHA ensures that they don't have to technically be the primary residence. This Indian tribe is allowed to hold the title, right, under their association, and the person makes their regular payments to FHA on their loan, and the amortization goes down. The Indian tribe isn't getting anything other than their 0.5% fee in the beginning, right? And then whenever the person actually gets their credit score up, or in many cases gets the 2 years on the job, like because it literally is 2 years, like not 1 year and like 11 months, it's 2 years, and a lot of people are missing that. So anyways, when they're ready, when they now qualify for this deal, they do a loan assumption. They assume the loan from the tribe at no fee, and the loan's in their name. The pay down that they paid down, on the loan amount is there. So like that's something people like don't know about. Every situation is different. I think first thing someone should do is try to get pre-qualified, because the best thing is maybe buying on your own. But then, like we were talking about, if you're missing a piece, like the credit or the down payment or the income, partnering. I've seen people do it over the years, partnering on the piece you're missing, and you can just get going right away.
And listen, this is for all of you that are listening. What he just mentioned and what he just said is why you hear me say this all the time. Who you work with matters. This is why it's important for you to team up with someone that knows what they're doing. Not to constantly be pitching myself, but I've been doing this a very long time. And as I just mentioned, if I don't know the answer, I have someone like Aaron that does. So either hit me up. I'm going to have all of Aaron's information down below. Hit him up because, and Aaron mentioned it. Where there's a will, there's a way. And and granted, there are mortgage people out there. There's real estate agents out there that are lazy, and that's just the truth. They don't, when they have a case like a person that's missing a component, or a person that's looking to get into these grants that really take a lot of time and effort, and there's really no extra money for the agent or the mortgage broker. But like Aaron and like myself, this is what we want to do, right? We want to help people like yourself that are missing a component, or need, or brand new to the industry and want to get into either your first property. And more importantly, and I keep stressing this because I firmly believe if you want to set yourself up for the future, you have to look at real estate as an investment. Don't look at it, or I'm buying this place for me to live in it. No, that's going to be your investment and could potentially be your pension down the road, right? So security is not going to be enough for you to live on. You're going to need something extra. And a lot of people, unfortunately, don't know how to save and don't know how to invest. But everyone needs a place to live. So using and having the mindset that where I'm going to live is not only going to be the roof over my head, but it's going to be my investment vehicle is important. So I'm glad you mentioned that, Aaron. Is there anything else you want to add to that?
Just to stress, like the only thing that gets in people's way, in our own way, between, buying that first house or buying that skyscraper is our own minds and our
Yep.
limiting beliefs, really.
No, I can't I can't agree with that more because, you know, and I just recently heard, I don't know if anybody watching knows who Vivek Ramaswamy is. I can't pronounce his last name, but Vivek was a presidential candidate now in the 2024 election. And he just talked about in an interview, what's his next step now that he's not running for president. And he mentioned how he wants to do something big. And the reason and they asked him, well, why do you want to do something big? He goes, because it takes the same amount of effort to do something small and something big. The effort's the same. You still have to go through the same procedures, same processes. Everything's the same, except he's going to do it at a grand scale, right? So the same thing here. It's just your mindset as to what your capabilities are, and almost always your capabilities are 10x more than what you really think you can do. Uh, so I mean, I got.
Adding
Go
to
ahead.
that, it's like taking the time to actually write down a 5-year plan. That's big because a lot of times we get stuck in our day-to-day grind that, the thought of like getting a 40-piece rental property is like, that's not, you're not thinking about that. But if you think about it in 5 years and 10 years and look like how you can really map things out and get there, it's totally doable. It's totally doable for like anyone. And like Fernando, a lot of people in real estate who are really successful, like they're not even really that smart. Like you don't have to be that smart at this. That's why I like it.
I love it. I love that because I tell people all the time, I am not and have never been the smartest person in the room. Um, I just happen or have the ability to understand that there are no obstacles, right? If there's an obstacle in the way, there's a way to get around it. I just have to figure out what that is. And sometimes I figure out quicker than others, and sometimes it takes me a little longer, but eventually I figure it out. Um,
Yeah.
so along those same line, about figuring stuff out and taking that leap, in your experience, what's the most common mistake that first time home buyers make or first time investors make when they're trying to buy a property?
Bro, we could have a whole comedy special on this. But buying the furniture for the new house before the loan closes is a common one, believe it or
Wow.
not, because they open up credit cards and that like anything that happens on your credit during the loan process up until closing day is being monitored, you know. So if you open up a new credit card to get $20,000 worth of furniture, that could throw off your debt to income ratio and your credit score. Like, so don't do that. Um, don't put large amounts of cash in your bank account, uh, within 2 months of when you apply because they go back 2 months. And, a lot of people have cash depending on the culture you're from. And, I'm ready to buy my house. I'm going to go put 10,000 in my bank account. Like everything that goes in your bank account for 2 months leading up to your closing is scrutinized and your deposits have to be explained and documented thanks to the Patriot Act. So that's a big one. Um, yeah, that's it. But I think the biggest thing is people get in their own way of why, like they have some reason in their head why they're not ready to purchase yet. Maybe it's a down payment. And that's the biggest thing I think is getting in their own way,
Yeah.
on things that are solvable that they don't even know about.
No, I agree. And then the second biggest, and the only thing I'm going to add to that is that uh, uh, I find that a lot of people will get excited about a property, then they'll start telling their friends and families about it, and then they'll allow those friends and family or close relatives to convince them to not do it. You know, oh, you sure you want to do that? And then you start to think, do I really want to do this? Do I, there's a risk in it. Listen, uh, when you're buying a property, keep it within the people that need to know until you close. And once you close, then you can share it. But I see it a lot, and I get phone calls. Oh, I'm having second thought. The inspection came in, and I found this wrong. What every property is, even a brand new construction property, when an inspector goes in there, will find something wrong with the property. Uh, so
Don't listen to somebody unless they've already done it themselves and they have a bunch of properties, right? Don't listen to it.
exactly.
Why would you take advice from someone who has only had one house their whole life, right?
Exactly, exactly. Now, a couple of more questions before we wrap up. Is there a difference, or what is the difference between a residential loan versus a commercial loan?
Um, well, if we're talking about the property itself, it's anything 5 units or more is a commercial property, right? But even under the residential section, like a 1 to 4 unit, you can get what they call business loan, also called a DSCR loan. I love those loans. Those are really popular right now. Um, the thing is you don't have to show income documentation, no tax returns, nothing. The deal is qualified based off of the income that the property can produce. So as long as the monthly rental income is going to be more than the principal, interest, taxes, and insurance on the loan on the payment, you know, you qualify. So that's technically a business loan. Those are interest only, by the way, which as an investor, you learn to love interest only, right?
Yeah, which was my next question, because I'm very interested on this specific loan, because I never thought about using. I've gotten commercial loans for larger deals, but I've never thought about using a commercial loan for like a fourplex. Interesting that you mentioned that, and I wish I had more time because I want to dive into that. But I want to ask this next question in terms of the difference between like interest only, adjustable, and fixed.
Hmm. Traditional mortgages are principal and interest, right? Over 30 years. And then the next step down is interest only. So you're only paying the interest, no principal payback. Your grandpa and grandma are going to hate that idea, but a lot of times that's saving you quite a bit of cash every month. And as someone getting started out who's using leverage to their advantage, you know, if you're not covering all the monthly expenses on a property, it's like an alligator, it starts eating you up. So the interest only provides a nice cushion usually for cash flow reasons.
And how
Um,
long? How long are the terms for an interest only loan?
So right now, like specific to the loan, but generally speaking, interest only for 10 years, right? And
Wow.
then it flips to principal and interest. So it actually doesn't balloon, it flips to interest, principal and interest.
That's
I
people
know.
that's gold. That's gold, especially in today's market when finding a cash flow in property becomes difficult. But I've always said, in real estate, you should buy property and wait, not wait to buy property, right? So getting into the game is important. And this interest only loan, especially if it flips over, um, well, let me ask you this question before I finish my thought. Because so let's say it's in 10 years it flips over, but let's say my financial situation gets better, the interest rates are really good. Can I switch that earlier than 10 years to a fix?
Um, that would require a refinance.
It's a complete different path. I can't go
Yeah.
for
It's
that loan.
not like sometimes on home equity lines of credit, which are awesome if you have a primary residence, those those work like that, but like, you have an option to fix it or something, but generally on the business DSCR loans, there's no option. You would just have to refinance it into a new loan.
Okay, okay, okay. That's good to know. Um, because in case you guys don't know, the refinance when you refinance them, you have additional costs to the refinancing the loan itself. It may or may not be beneficial depending on your situation. But I was just wondering because if you can actually flip it sooner to a fix without the actual or
Okay, so there are no, there are options though. It's just something you would have to design. You would have to decide at the time of closing. Like, do I want 5 years of interest only or 10?
right. Okay. Now, we're going to close with this. What advice would you give someone looking to transition from being a homeowner to becoming a real estate investor?
I don't know. Then it's case by case, right? Because sometimes that might require like selling your house, maybe if it's not a good, you know, a good move. I think you got to evaluate it on a monthly like basis of cash flow. What's the smartest thing to do? Maybe it's to do a renovation on your current primary residence. Add, like we said, add a mother-in-law suite. That's what buyers want right now. And you generate that extra income without having to buy a whole new house. Yeah. Or if you have the money, if you have the 20% down, I mean, I would say just get rocking and rolling and use the DSCR loan, buy an investment property, you know? And I think people should base it off of an annual rental basis, not like Airbnb numbers or something. I see that mistake a lot, you know.
I'm glad you touched on that because I'm gonna close on that statement. I'm closing on two things you just mentioned. Number one, I firmly believe that the easiest way to become a real estate investor is to do one or two things. Either if you're currently owning a property, figure out if you can add an additional unit to your property. It's really the best way to do it because number one, you're currently living there, that expense is not an extra expense, with the exception of the construction cost that you can get the loan for to build. But by doing that, you increase the equity and the value of your current home. You're going to have an income, and it's going to allow you to give you time to figure out if you want to be a real estate investor or a landlord. Um, because being a landlord, and this is where I think a lot of people make a mistake in, is a lot of people will get into buying properties and then they want to do it all themselves. And I tell that's a big mistake because most people do not like being landlords. They don't want to deal with the tenant calling them that the toilet's backed up. They don't want to deal with the tenant calling them that the property's starting to get roaches because the tenant's not clean. They don't want to deal with collecting rent. So it's important that you still become an investor because I firmly believe in real estate. It's the easiest and most viable way for you to build financial wealth, but let the experts do the job. So, for example, if you decide to become an investor, get with true professionals. Get a mortgage broker that really understands how to cater to investors. Get a property manager that's going to manage the property once you buy it, and deal with a real estate agent that understands and that caters to investors. Most agents, I'm going to tell you right now, I'll probably say more than 90% of real estate agents, number one, probably don't sell more than two or three properties a year. So they don't really know how to be realtors. And worse yet, they don't deal with investors. So they just, whatever they see on the market, oh, that's a good property, it's going to work for you. And most of the time, that's not the case. You want to add,
Then can I
uh,
throw some in there? Like,
yeah,
yeah, I was actually thinking about our conversation because this is really cool. Like, I've been dying to like mine info out of your brain. Like, we really don't know each other that well, so like I love this chance to talk to you. But like, at what point does someone decide like, okay, maybe I want to have a landlord or be the landlord? And I think that's like when you get up there in properties, once you maybe get 5, 6 properties, then maybe you can say, okay, I want to make this my full-time job. But then again, like, this is the way I do it is I don't manage any of my properties, because I want to do this in a cool way. Like, I want to have a cool life. I don't want to get called on Sunday afternoon that the toilet's clogged. Like, So you can pay someone else to handle that problem for you. And let's be honest, and do it probably much cheaper and better than you would do.
And
Right?
that's my point, because I think um, a lot of people get into there's two things that I want to touch on. Number one is a lot of people think they want to get into or become real estate investors. They do that. Let's say they get 5 or 6 properties. They realize it's a lot of work, very time consuming, and the main reason people want to do it is to build wealth and to gain freedom, time freedom, right? But as a real estate investor, especially you have a large portfolio, if you're doing all the work, there is no time freedom. So, like you, I highly
And
recommend.
you don't have the mental energy to be the dreamer to really create the idea in the first place if you're working all the time,
Right,
right? You
right,
need to have that energy to come up with like these ideas that other people don't see. And
ex- yeah.
I think there's a lot of truth to that.
No, no, exactly. And that's why, the other thing I tell people all the time, when people come to me and they're like, hey, I want to start being a real estate investor. Uh, when I dive deep that question, I asked why, do you like what you're currently doing? And if the answer is, yeah, I love what I'm currently doing, but I want to make more money, then my response to them is, okay, be a passive real estate investor, meaning hire people to do all the work, and reap the benefits of investing, but without you having to do it. Because if you have a good W-2 job, um, keep doing that, right? If you like what you're doing and you're making a living, keep doing that. Use real estate investing to build wealth, but for the future, right? And more importantly, and this is what you kind of touched on it in the beginning, banks like W-2 people. They don't like 1099 people. So as a W-2 employee, you can use leverage much more than a 1099 or self-employed person.
Let's
So
add something here. This should have been my answer to the earlier question. What's a big mistake people make is that first house they buy is way too expensive
yes,
because they get caught up in there and they're never able to save up money for that next move.
I'm glad. I mean, I'm glad you touched on that because I wasn't thinking about that as well. But that is so true, so true. And I'll use myself as an example. Um, my first purchase, I could have bought a lot more. So I'll give you an example. I bought my first purchase was a condo, or one of my first purchases was a condo. Right? I've could and I paid, it was 20 something thousand at the time. Uh, but I could have bought another house for in like 120,000. But I didn't do that because I needed the ability to save money. If I bought that $120,000 house, all my money is, it's the term house poor. I would have been house poor because all my money is going into this large property versus.
And also, like on a math level, your DTI, your debt to income ratio, would have been much higher and probably not let you qualify for number two.
Number two, correct. Anyway, I love the conversation. I'm going to go ahead and end it there. If you guys got value out of this, please hit that like button. Subscribe if you haven't subscribed. Follow me on Instagram. I'm going to have all of Aaron's information down below. Love you guys, and I'll see you in the next one.